how to trade in just 1 or 2 hours to make a living day trading. In this video, I'm going to show you a full trading strategy, and a trading strategy that you understand what it is about. It's always about a rule set. A rule set means, for example, how many times are we allowed to trade per day? Or like how many times are we allowed literally per week, about money management. And then also what kind of signals are we allowed to trade. So here you can see, and this is something what's very important. If you're not doing an Excel sheet yet, even as a beginner, you're not making a money making activity yet, because the money making activity in trading is to collect signals. And once you collected them, it's all about looking forward which of these signals that you see here. So each of these, here is a signal. You have like 20, 30 signals, as you can see here on this page here. And each of them is a signal where we can put in $100 to get $500 in average out. That's the quality of the signal. And then quantity is also very important. You can see here how the trader just trades for 1.5 hours, maximum for almost 2 hours. Like actually 1.5 hours, you can see an average, and trades the Euro, US dollar, or the S&P 500. In your case, if you're from the US, it will be Central Time, 9 a.m. between 9 a.m. to 4 p.m. somewhere 1 or 2 hours, trading the S&P 500. Why? Because the Euro US dollar, for example, has a money exchange of around like 36 billion a day, but the S&P 500 has a money exchange of 120 billion a day. That means you will have way more signals, and it's just like you'll find more trading signals and you will find more movement with those trading signals that makes more sense for your trading. So first of all, did you understand? So it's important to have a trading signal within this 1 or 2 hours that you're trading to adjust $100 to make $500. And then it's also important that you understand also we need to have the signal so often as possible. And what we use is price action. That means just a color switch, such as a red and a green candle. I will show you here an example. That means if you are, depends on what time zone you are. Let's just take New York time zone. And then we go here anywhere between like 9 a.m. to 4 p.m. That would be in this time area here. On different kind of videos, you will find also student results and also trade examples, or from me also, for example. But this time we're going to look at this one on the chart. That means you need to look forward that you're trading for 2 or 3 times a week in a cycle of 5 weeks. Make sure you always make a picture of the current day. I will show you how. That means, for example, if we start our trading here, make sure that you draw in a square like this, 1 hour front, that around 60 candles can fit, for example. Like if it's 4:10 right now, we do it to 5:10, but only between 9 a.m. and 4 p.m. is very important. And then just draw in what the past 60 candles did. That means the past hour. And then you'll see here, oh yeah, so past hour, the market was doing this one. Those are 60 candles here. This was the average length. Then place it in front where it makes sense. If you see, for example, the market, it makes right now sense that it goes a bit higher because it goes higher here. Put the square in front and then take a picture while making this one very small like this. Very important. So when you do that, you will understand better in what direction the market is going at. And then you can also clearly see, oh, there's a high. And the next high is up here. And because this high here has such a big difference, as you can see a distance, it makes actually sense that the market just like, because the market couldn't push through here, it just makes more sense actually to assume that the market goes this. And then you're waiting for what the market is actually doing. And this will train you by understanding what the market does. That means if you see that the market is going up, the market likes to go to a high, then it goes back very often, it retraces or even goes in a consolidation phase, what happens right now. So we cannot assume that the market goes here to the next high up here. Why the market likes to go to highs and lows is because if you see that the market, for example, was going down here, then people were also selling. And these people who were selling have placed a stop loss. So if you don't know what a stop loss is, it is something they say, like, for example, they are selling here on those red circles. And then from red circle to line, they're placing a stop loss, for example. And they say, for example, they only want to lose $10,000 in average. Just as an example, here also $10,000 in average, and here also $10,000 in average. So just different kind of traders. And so when there's an auction process, the market is also going now here higher. Check this out. Now people were buying here, for example, and they have their stop loss here. And they also maybe want to have adjusted, for example, $10,000. We're just taking this one out of the blue that you understand, just like it's just some money. So in the auction process, now it's important, do you find more people that wants to trade up here that these people lose money? Or do you find that the market wants to go to this low, that people lose their money? So either side, if one of these sides is losing money, they will also make money. And the main reason is following thing. In trading, you can buy and you can sell. Let's just make a buying example. For example, if you buy and the price goes up, you only make money if you sell. If you buy and it goes down, you would lose money, but you can only realize that either it breaks your account literally and then it will force you to sell, or you need just to sell to just realize, just to get your money out. This is something what's very important. So you can imagine there's always like a +1 when you enter the market. But then when you want to exit the market, you need to make a -1. That means selling, that it's on 0, that you're out of trade, and you just realize if you have that cutoff of making money or losing money, depending on if you bought or sold, right? So just imagine if here is a buyer, somebody wants to buy here, and somebody's buying a lot, he can't just buy really a lot, or else he would move the market. So what is happening is he's literally buying the market, pushing up to a high. And this guy here was selling and he has a stop placement here. That means if he wants to realize his losses, he needs to buy. That means just assume like he was selling for 10,000. That means to exit, he needs to buy. That's why like people who sold have a buy stop, it's called. That means like here, for example, you can find in here a lot of people are literally buying then, and then it pushes the market up here on this high because people are losing money. So now here's the thing, because it is pushing the market up, what somebody can do is, just to keep it so simple as possible, instead the market is pushing up, somebody can absorb that movement and then literally sell inside here a lot. That means literally on each high, people can sell here, and then if there's enough being traded, then the market to push down. And this is one of the main reasons why you don't want just to sell on a high or a low. I'm going to show this to you on the practical side. That means if you look at structure, never mind the candles too much first, like let's just take your line based. You'll find here this high here. The next high will be up here, but you find here smaller structures. This is just a 1 minute chart and it's totally enough. And then you'll see here how the market is going there to this high and then just goes in a consolidation. Just imagine you want to make money trading. So when you want to make money trading, you need to see that the market is going in one direction. That means either you see that the market is just staying on one price area, such as here it's 6356.75, or as you see here that it moves to this specific high here, just in one direction. Here you can see also consolidation phase it's called, but it's moving upwards, what is very nice. But this consolidation phase is just staying in one price area. And when it stays in one price area in the S&P 500 futures, if you just open trading view, it will be ES1 exclamation mark. This is exactly where it gets dangerous literally, because we can't make any money there because the market is not moving properly. So as you see here, for example, very big structure low is down here, for example. You see how the market is touching it. And then before the market is going up, the market is for many hours just like staying on this price area. And this is just something very important for you to understand, that every time you see a high, such as here, just don't try to trade against it. It will be better to trade towards it before the market is reaching it. So again, if you start your trading, make this kind of picture in the beginning with the path what I showed you, with the 1 hour box or 2 hours box. It depends on how long you're trading. And then you make a picture afterwards. And if you do this, then you will gain more experience by understanding in what direction the market is going out. I'm going to show you here, for example, an example picture. This is, for example, what I mean. Like you take a picture in the beginning, it would look like this. Like you just see like a bit here, the market is wiggling around. And then afterwards, you do a second picture and then you see how the market was really doing around this move to this high here where my mouse is here, right? This is just something what is very important for market experience. And you do this minimum 10, 20 times to gain first experience in what direction the market is going at if you trade for 1 or 2 hours. Once you did that, you want now to understand before the market is reaching a higher low, can you see, for example, here does a lot of red candles. And when you look at structure, this is a very big structure low. The pre-station is here. Like we have here these lows here that are very close by. And because these lows are close by, it means like many times the market goes within 5 minutes just to these lows. But it takes longer times to, way longer time to this low because there's a huge distance. And then the next station will be here. And this will be the main reason why we can expect literally a movement on the right side. You'll see that. That the market is literally going down like this, goes down to the low like that, goes back, retraces a bit, comes down, and then here retraces a lot of time. I It's a lot of time. And then somewhere, anywhere, it tries like to go up, and then anywhere it tries to go then down here and then here, right? So you can see it tries always to retrace on the first touch. This is what we should expect. This is experience that I can give you here from this video. And then now you'll see like here, these targets are nearby. That's why you can see like within 1, 2, or 3 candles, the market was just like going through. And then from here to here, there's this big distance from low to low, as you see here. People are defending it. You need to think tactical a bit. You can see how the market is not making it within one push and then first goes down as I just draw it in. So what we want to find here is how to adjust $100 to get $500 trading opportunities. And that is to find a color switch. So the green candle opens at the bottom and closes at the top. And the red candle opens at the top and closes at the bottom. Depends how experienced you are. You want literally to do it like this, by the way. By the way, if you want this one to get implemented, just go to tradewithjd.com. We can meet up in person online and talk about your situation, about trading. I hope that I can help you out with this system to implement it, that you can trade, making a living even if you want to, by trading just 1 to 2 hours. It's just important that straight off in the beginning, it's important to make it as a side income. And then one day, if you get good enough, and of course have enough savings from your trading, like money made, then it's possible also to make this a living. Just go to tradewithjd.com and then you can sign up there and set a specific time that we can meet up. Okay, look at this one. So you find here a color switch. The green candle closes at the top and the red candle closes at the bottom. And you find here the risk reward ratio is 6 point something. So you just want to have a risk reward ratio of 5 until this target that it's realistic. And you can see it happened 1 time. It happened 2 times here. What was possible? This one would have been a stop out, this color switch. Let's go to the next color switch that you will find here. You find here lower green and red, right? And then here, for example, for this color switch here, you find also a risk reward ratio of 5. And you first want to do this first in a routine many times just to understand your trading signal and when it makes more sense or less sense. And then you want to list them in an Excel sheet. Just keep it simple. Just say like, this was the market. This was the 1 to 2 hours. Like you were trading from 9 a.m. to like 10 or 11 a.m. You saw 1, 2, 3, 4, 5, for example, trading opportunities. We can adjust $100 to make $500 because that's the risk reward ratio of 5 that worked anytime. And then, for example, here you can see how the market does here a lot of red candles, how it retraces. There's retracement here, for example, does the same length from here to there. This is just something what's very important. It means like you don't just take this color switch down here. You would rather like wait until the market retraces. And then before first time the market touches even the low here, as you can see here, this is something what is very, very, very nice for your notes. And then you're aiming first. Well, this was a student result that was traded, as you can see also on the right side. But you first want to list them as a learn trade, because a learn trade says here are $4,000, here are $5,000, and again like $4,000. You just have a lot of money that is available in trading signals that looks the same, that is the same market, that is maybe even to the same trading time. And then once you understand it, you want then to understand, for example, like what I really like is, I'll show you this one here in the Excel sheet. Is that where do we find, for example, more green candles than red candles? Do you have more length in one direction? Do you have more candle groups in one direction? Or obvious market pressure? That means, for example, you see here when you make the chart small, most candles were up here. And you see how the market is pushing away. And when you just think about stations, so when there's a trader up here, or when there are people who traded a lot up here, people like to trade at where people were trading a lot already. Then just look at here. You find that people were trading up here a lot and here a lot, right? So these are 2 different kind of stations. And the next station is just here, so far away that it's not interesting anymore too much for us. As you can see here, it's just too far away. So for that reason, that makes those trades so good, and it makes that trades down here so bad, because you can see here, it's just like you just have a couple of lows here. Like here you have a low here to target at, and you have here then this low here to target at. You might find also here a color switch with a 1 to 5, but you find here also that this red candle is just so long that when you adjust your $100, it's not a $500 trade. And for that reason, it's just so important to understand the market better by just doing these 2 pictures that I just explained.